Hi there, everyone, and welcome to this month's edition of On Track. I'm Rob McGregor. It's the 28th of February and bring you all the investment results up to the end of January and all the news right up to the last minute. So, as always, I'll just start by reminding this presentation is for clients of McGregor Wealth Management. For anyone else who's watching, feel free to take what you like from it, but please get advice that's specific to your own circumstances before using. We're going to cover today important economic news. We're going to look at what the markets have been doing, the returns of the portfolios, update on our hot topics, inflation, interest rates, and the economy, and we'll dial in and have a look at what's happening with property and shares. And as usual, try and put into perspective the news and the impact it has on investments. So let's have a look at some of the news. And the ASX in January was up 1.2%. US shares, as well as Aussie shares, were up for the third straight month in a row. So 3 months all up. February is consolidating so far, but no major changes. The start of the reporting season, so the reporting season's just as the companies on the ASX start to report, has been solid so far. It often is. We need to watch the whole of the season unfold to work out where company profits are landing compared to expectations. GDP growth is back up, and this is really important. So in the US, it's back in the 3% range. So all the predictions of recession were wrong so far, and likely to stay wrong. You know, inflation numbers are lower around the world. The markets are now factoring in a soft landing, which we were talking about as the Goldilocks option. So it still looks fairly probable. It doesn't mean it can't be shaken off, but you can see the chart down the bottom here that shows, inflation has just fallen back down. And when we go through the numbers on the right-hand side, no change to the RBA cash rate. It remains on hold. Much speculation about when the rates will drop that range anywhere from April through to next year. Nobody can tell, not even the Reserve Bank. It'll depend on the data. If the data shows inflation dropping quicker, rate cuts will come sooner. If the data shows inflation being more stubborn, rate cuts will be delayed. And if inflation happened to run away, again, which seems unlikely, then rates could even go up. 90-day bank bill rates pretty steady in that same zone as well. 10-year government bond yields at 4.16%. So note that you get less for a 10-year bond than you do on cash at the moment. So cash is at an extreme high at the moment. Normally cash rates would be 1% below government bond yields, but they're still high as inflation's coming down. Aussie dollar, pretty stable the last few months. It's bouncing around a little bit, but right around the mid 60s, so 65 and a bit. Aussie inflation, the number comes out right after I record this each month, but we can't kind of wait for it. But last month it dropped from 4.3 to 3.4. We'll see what happens this month. The US is dropped. The US is stubbornly above that 3% range, but 3% is a 9% that it kind of got up to. So the war's won, and it's just trying to, they're trying to squeeze it back into that 2 to 3% target range. Mortgage rates, no real change. It's interesting, Macquarie's offering slightly cheaper, and they're offering slightly cheaper on their term deposits. So they've dropped both term deposit rates for 1 year and their mortgage rates by 0.1%. So not too much. And the other news, which important to not many people, but important to us. So the group that we're part of, GPS Wealth, has a new owner. So GPS has been part of the Diverger Group, which is an ASX listed company. It's now part of the Count Group. Well, it will be effectively the 1st of March. I'll talk about that in a minute and give you an update. So right now, actually, so just a reminder, McGregor Wealth Management, our practice is licensed through GPS Wealth. That just means we hold our license through GPS Wealth. And a bit of history, GPS Wealth was started by myself and Greg Holman in 2011, has become a national group. We sold that to a listed company, Diverger, in 2017, who's happily run it. It has no impact on our day-to-day business. They take care of all the licensing, the regulatory stuff, the compliance and all that things, and then it saves us having to run our own license. Now, Diverger has been acquired by Count, which has an ASX code of CUP. So if you want to dive in more details, you can see this in stock exchange releases. But the important thing is no real changes. Now, GPS Wealth owned 35% of McGregor Wealth, just in cross shareholdings that came out of our history, that will now only count. So I own the remaining 65%, and so far I've been working with Count for the last 2 months as they've gone through this process. I'm extremely happy with our new partners there. No change whatsoever to McGregor Wealth Operations, no change to our people, no change to anything that we do at all. One of the reasons that Count bought Diverger and GPS Wealth was because of the attraction and success of the care investment process that we talk about. So there's the potential that it will be used in other places within the Count group, and there'll be no change to the day-to-day operations of care or the investment committee. And at the moment, I contract about 20% of my time to GPS Wealth via Diverger. That contract will continue through Count. So I have a seat at the table in that very successful group and continue to train and mentor advisors in that group. So no change, just a new shareholder. And that's a compliment to the success that we've had rather than any threat. So yeah, please, you'll see some correspondence in the next week. If you have any queries at all, please yell out. But no changes to anything that we do. So the care portfolio returns to the end of January. 1 year returns still showing really solid numbers. 7 year returns are almost bang on track with our long-term predictions, with high growth coming in at about 8.5%, which is bang on inflation plus 6%, slightly over. Inflation was under that for most of that period. So yeah, even though we've had so much volatility in the last 7 years, the long-term returns are very consistent with what we allow as our targets. We've made no change to our market view and our money on the move dial. So we still have that at 8, which is just a touch over fair value. And I note that right about now is about 10 years since we started the care portfolios and the money first in. So I expect that in the next few months, we should be able to show you 10-year returns. And I can confirm that our 7-year returns remain in the top quartile or better across pretty much all periods. So we're extremely happy that we're able to deliver results consistent with what we would hope, and that allow us to plan your futures with a high degree of confidence. So you can see the top right-hand corner of this chart, which I update every month, has now popped into the new high territory, which we talked about last month. Despite climbing all these fears, the wall of worry that we talk about, and the market is still continuing. The latest worry, which we've climbed out of, was the fear of inflation. So we're now moving into a new era. I'm sure new worries will emerge, but I'm sure the market will continue to climb as always. And at some point, we may actually enter a boom where there's no signs of that yet. There never is at the start, but it's now been 20 years since we started the last boom. So it's coming into its overdue time sights. Not to say that's going to happen, but it's certainly on the cards in the next 5 to 10 years. So let's have a look at one of the hot news this month. NVIDIA, which is a company that is in 2 main areas. So some of you have heard us talk about the Magnificent Seven. In the last few episodes, the Magnificent Seven, 7 biggest companies that are involved in AI, includes Tesla, Facebook, Amazon, Google, and NVIDIA, and a few others. But NVIDIA is the one that's hot. And their profit release came out in last week, and their quarterly revenue was up 22% from the previous quarter, up 265% from a year ago. And 265 is nearly 4 times, so 3.65 times. Keep in mind, revenue up 100% is a double, 200% is a triple. So this is nearly up 4 times from a year ago. Their profit is up 126%. So you can see their share price down the bottom. And the good news is, because of the way we invest, because we have index investing and a focus that includes overseas shares, you automatically have this in the portfolio. So part of the reason the results have been so good, when we go back and look at the 1 year results, you'll see that international equities is up about 23-24%. A big part of that is NVIDIA, and a big part of that's the Magnificent Seven. So the beauty of the way we manage money on your behalf is you don't have to think about that. You don't have to decide whether it's bought. It's in the index. And you'll see when we go through some of the individual exchange traded funds, you'll see how that fits in. Yield curves, pretty boring. It's now starting to steady a bit despite that spike and that last fears of inflation that came through and that saw the October lows. And as the fear of inflation has dropped, that rate's settling into about 4. Where will that sit? What will the new normal be? We kind of assume it's going to be in that 3.5 to 4.5 space. We don't say that ever with any certainty because we know that things can change in the world pretty quickly. But we think that's kind of right now, with all the information, roughly where the new normal is. And that means over the next year or two, cash will probably settle down from where it is at the moment in 4s, probably settle back into the 3s. And of course, that means mortgages may come back as well as we see cash rates drop. But we'll hold our breath. We don't know whether that comes in the next 2 months, 3 months, 10 months, or longer. And that will depend on the data, as I said. So let's have a look at one of the boring things that makes us money. One of the reasons that the portfolios have done so well over that 10 years is a boring little thing called rebalancing. So you'll see on this, the back of this chart shows the market going up and down. And as the market goes up and down, it presents opportunities for us to rebalance. So this is an extract from our investment committee report from a week ago, and it shows that for the balanced portfolio at the moment, you'll see we have a benchmark allocation and we have a floating allocation. So that benchmark allocation, we haven't changed during the last 10 years. We still think that is a very good strategic asset allocation. We absolutely make changes in the other areas of care, but this is the C. So we hold that long-term strategic asset allocation deliberately. And then each month we see what's gone up, what's gone down, and we rebalance. So in this month, you can see that the Vanguard Australian Share Fund has gone up to the point where we now have 30.9% in Vanguard. So if we're triggering a rebalancing, we'll sell a little bit of Vanguard and we'll buy a little bit of the negatives here, in which case it's fixed interest. The US share market also about 0.48 above benchmark. So we'll sell some US shares, we'll sell some Aussie shares, we'll buy some bonds and some of the others. Now, what happens is the market then goes the other way. And you'll see a typical example of COVID. You can just see COVID here where my cursor is in 2020. When the market dropped, we sold off bonds and cash and bought more shares. And as the market rebounded, we reversed that back to the benchmark allocation. When we do this, this makes us money because we're forced to sell high and buy low. And that's the simple recipe for making money. So rebalancing adds about 0.5 to 1% of the portfolio. So it pays for a professional portfolio management and then some. So just one of those boring little things that gets done. You don't have to think about it. And it gets done for all our clients consistently as we meet for the investment committee. As usual, our money on the move context, and as I said, the dial are just over fair, and certainly nowhere near any of the scary bits of FOMO, etc. And I'm going to buzz through this as I get through some other topics today. But yeah, just talked about rebalancing. And the focus that I wanted to talk about today, and I haven't highlighted, but short-term focus, but just how costly that's been during the last 7 years. If someone was so focused on inflation and fear of it that they stayed out of the market or they tried to make trades, they missed that return where the market went up 8% over that 7 years. 8% over 7 years is getting close to a double. Your investments will double every 9 years of an 8% return, assuming you're reinvesting income. But of an 8% return, someone withdrawing 5% per year in pension phase will hold their capital steady after inflation and then some. So the importance of not focusing on these short-term issues that come and go is that you get to enjoy the gains when they happen suddenly. And you saw how suddenly the last 3 months we've had 12% up in the markets around the world off those lows in October, where we're still worried about inflation and wars and all the rest of it. And that's because the good companies of the world keep making money. So that expands into one of the behavioral biases, which I've talked about before, but which I revisit regularly, which is recency bias, which is a bias where we tend to place more weight on current news and current events, which means we start to think it's way more important than it actually will be historically. We do this because we're humans, we're flawed in the way we think. So anything that's in our face right now seems to be way more important than it will turn out to be in history. And that means those of us who stay strong as long-term investors prosper from the fact that other people will panic in the short term and push markets down. And this actually presents opportunities for us to hang on, or in fact to buy, or to do things like rebalancing, or to continue our dollar cost averaging. So that delivers us better returns than other investors. And that's this behavior gap, which I'll revisit. And the behavior gap is simply the fact that the returns that investors get mostly are lower than the returns that their investments get, which sounds kind of a tongue twister, but it actually means people don't just buy investments and hang on to it. They chop and change. And this is most people, not our clients, because our clients have a good process that is followed. But you can see in the past that wishy-washy stuff has cost investors, an average of 3 to 4% per annum over time, which is quite massive, particularly in a low return world. So that's one to always be wary of, so that we shouldn't overinflate the importance of whatever news is here at the moment. And by the way, whatever news comes out, it's into the share market prices instantly. So you can't actually trade off it unless you're predicting something that the market doesn't know. That's just reiterated by one of our pillars here of learning from history, that it's about time in the market, not time in the market, that we predominantly will buy and hold, with a couple of exceptions that are based on your circumstances and the occasional out of whack market circumstances. Let's have a look at all the individual asset classes. Aussie shares just up over 1% for the month. But what a volatile year. Look at the path that we tracked over the last 12 months. The market was up and down, up and down, up and down. Then it went down, down, down to the end of October, off that fears that inflation was just being stubborn. And then look, bang, up 3 months running. So we end the year up, and that's with dividends on top of that. So a good year. And you can see that flow through in the chart down the bottom, which shows the growth of $10,000 over the last 10 years, to the point where the index has turned 10,000 into 22,000 for reinvestors. You'll see the top 10 companies, no change here in Australia, dominated as usual by the banks and their big miners, BHP, Fortescue, Woodside, and also Wesfarmers in there, which is quite diversified, but the big four banks plus those, plus CSL. As we go to US shares, we'll see NVIDIA, who I was talking about, and now the third largest holding on the US share market. So in the index, it now accounts for 3% of the weight of the index. And you can see the 1 year return for NVIDIA, 240% on the share price. And by the way, their profit went up 265%. So the people that backed them a year ago were well rewarded. That includes all of us, even though we did it without having to think because of our index approach. It's got a forward price earnings ratio of 33, which sounds large, but it's not much different. It's actually lower than Amazon and lower than some others there, higher than Google and others. But none of these price earnings ratios are alarming. And a price earnings ratio is just the price we pay for the shares divided by the earnings. And the higher that is, the more expensive the company. You can read too much into that. I won't go into that. Maybe it's something for another episode. But to date, that you just be known that you own these stocks that you'll hear about on the news that are growing. We'll talk more, no doubt, about whether they're in bubble or growth. I talked about that last month. We don't believe this is anything like a bubble. This is justified by profits at the moment, and it's probably the start of what will be a long-term upward curve, but no doubt with volatility in those AI stocks, that magnificent seven. Global leaders, you'll also see NVIDIA here, once again, third to Microsoft and Apple. So that's another way you own NVIDIA, which is in our active portfolio, and that had a return of 7% for the month, 34% for the year. So this top 100 companies in the world is dominated by tech. One of the challenges of just investing in Australia is you don't get exposure to these areas. We're dominated by our financials, the banks and our mining companies, which have had some good times, but there's way less diversification in Australia. And we pick up this fast-growing tech sector by our international exposure. US small caps, where we pick up a huge amount of small cap exposure, up for the month, up for the year, and been spectacular over the last 10 years. Most of the companies in there, none of us will know, because this is the masses, and this is where capitalism in the US is the heart of all of this. And these companies, by the way, that we call this small cap because it's US small caps, but nearly all these companies would be in the ASX 200 or large caps in Australia as well. And they continue to outperform. the broader market over the long run. Emerging markets has been the problem child of the last decade, particularly the last 5 years, where it's only averaged 1.87%. It had another very low monthly return. In the long run, we know that emerging markets will prosper, but they're very low at the moment. They're very cheap. So part of that is the perceived risk of China, or what investors call the sovereign risk, that the government can make decisions that affect the local companies, as they have done. So similar companies that live in China, like Tencent and Alibaba, that are kind of similar to Google and Amazon, sell at a much lower price, even though they do the same thing. Now, they do that because they're worried about the Chinese government. Now, it's not just China. China's only 20% of emerging markets. It includes Taiwan, India, Brazil, and others, but still an important part of the portfolio. And eventually, it will have a run. There will be a time where it runs up, and we'll be glad we've got it in the portfolio. And anyway, that's why we're diversified, so that we pick up things as they go through the different cycles. Same for gold, important part of the portfolio, delivered 13% last year, which is a great return and has been invaluable during the crazy last 5 years of COVID, where it's allowed us to profit when markets have been scared, and it does tend to ease off when markets are going well. So it's a nice insurance policy effectively. We talk about our cycle in shares. We've also got our cycle in the property market, which we call boom, bust, boring, where the market is boring for long periods of time. Then we go into a boom, can have a little bit of a bust from there. It can vary massively depending on the regions. Generally, the bigger the cities, the less volatile the cycle. The smaller the country towns and the further away from the cities, the more volatile the cycle. When we look at the capital cities of Australia, the last year, all solid returns that range, with the exception of Melbourne. Melbourne's been the laggard with only 3.9% growth, but still growth in the value while providing with rental income. Melbourne's been a solid property city for decades and decades, and will no doubt continue. And we suspect it may be the beneficiary of a lot of that immigration at the moment as well. But Perth, 17.9% in the last year. It's been a place we've been very comfortable for investors over the last few years because it was in catch-up mode, and then 10-11% for Sydney, Adelaide, and Brisbane. So the average for all the capital cities in Australia, not that it's a very useful average, but about 10%. So a good year for property. Once again, even the last quarter, still solid. Perth, extremely solid at 5%. Melbourne, the only negative, but only a very small negative. What that does to the median value is shown here, which also shows monthly movements. I don't pay much attention to monthly movements, except how they stack up over time. But you can see the median values of cities around Australia. So as we look for investment properties, it's very hard to find quality investment properties under 600,000 these days. I know we include Darwin. Well, everyone includes Darwin in the capital cities. I would treat it as more regional. Darwin has a fairly small population, which makes it more like a regional market than a capital city market. So just revisiting the headwinds and tailwinds that we talked about last month, and there's no real change to that. So as far as the tailwinds, that's the positives for the property markets. We've got continued population growth. That is very good for property investors. It's not very good for renters. It's not very good for first home buyers, but for those of us that own properties, it's a good thing, even though we feel guilty about it to a degree. Now, the big one here is the high replacement cost. Something that might have cost $500,000 to build even 6 or 7 years ago now costs nearly $1 million to build. So the price of building has gone up by almost double over that period. So that means if you take a block of land that might have gone from 300,000 to 600,000, that might have had a house on it of 500,000, giving a total of 800. You've now got 600 plus $1 million, so you get 1.6. Obviously, that's a double as well. But that means people are looking to bid up older properties because they're doing their numbers on building, and it's adding up to very high numbers. So that's a tailwind. Massive shortage of dwellings from the population growth, which is going to take the next 2 or 3 years to fill. The story is different in every city. Watch this space in the coming months. I'll be doing a property update with our friends at Performance Property, So we're doing a planning session on that in March, and we'll probably record that towards the end of March. So watch this space. We'll do an in-depth analysis of property around Australia. Rents are rising because of all those same things, and consumer confidence, as inflation drops and interest rates falls, will also make people more confident about buying. And keep in mind, renters will be incentivized to buy just because the costs of rents are going up as well. So it's not all roses though, there's some headwinds. One of those is affordability. That always puts a dampener to some degree on price rises, but it's not the main thing. There's always someone that can afford properties. There's still some chance of slowdown, or that, even though I've talked about that chance diminishing, it's more just about slow or tepid growth going forward than rather a risk of a recession. Rates are still biting, make no mistake. Talk to anyone who's got a mortgage and it's still hurting. They're hoping for rate cuts and hoping that relief comes, but it's still hurting at the moment. That is still having an impact. The flip side is, as rates drop, it may provide a boost to property prices, ironically as well. We had a little bit of a rise in unemployment. It's been fairly modest, so this is probably dropping off the headwind list, but it's still a risk until we start dropping rates. And the other headwind was that people built up strong savings during COVID, but a lot of that has been spent. So they're now starting to deplete their buffers, and that makes particularly for the mortgage belt, that makes life a bit tougher. Mortgage rates, pretty boring. Almost no change in the last few months. Everything's pretty stable. So 6.42, the average fixed rate for 2 years. Not much difference for 3, 4, and 5 year rates. It's such a narrow band at the moment. And the average variable rate about 6.85. As I said, you can do better than that. Low sixes are very gettable. The lowest rate you can see online is about 5.95, but you shouldn't be paying 6.8. You should be revisiting, refinancing, or renegotiating with your existing bank. Keep in mind, a $700,000 mortgage, 1% difference is $7,000 a year. That can make a massive difference over time. No change. I haven't got an update on the changes in the property clock, but no real changes to the market that still show that where we are at different places around the country, as I said, not as I say all the time, not a perfect guide, but a great way just to think about where prices are relative to the cycle of property, where we've got some slowdowns in some area, but other areas still at the start of that cycle, particularly in Western Australia. As I said, in the next 6 weeks, you'll hear an update from us on a detailed update where I'll be talking to our friends at Performance Property about what's happening in the world, and they've got some of the best research that I see. So everything they talk about is research-based. Still doesn't allow us to predict the future, but enables us to make better decisions. And summing up, as always, we do have this fundamental belief that all investing is best done as part of a real plan. That's where we've got your goals, your plan, based on who and what's important to you. Portfolio is designed to get to those goals over the long run. We do take a long-term view because we know that works. And that means we can focus on the boring things, diversification, the right asset allocation, and liquidity that have made our portfolios deliver well above average performance over the last 10 years. We do that also by having low-cost index for most of the portfolio, not for everything. There's times where we don't use index, but it's always for a very specific reason. But the low cost means that fees are lower, that means returns are better, and protecting against that short-term volatility through the reserves portfolio for our retirees, through dollar cost averaging for our clients that are still working. That means you're putting money in every month, so that protects you against volatility. Well, you do that rebalancing that I talked about regularly, and that means that adds value over time as well. And as always, there's only 3 ways to lose money, and that is panic and sell, have to sell, and not properly diversified. Thank you, as always, for listening. I do appreciate the time that it takes to do these. We try and keep them snappy and try and keep to 1 or 2 meaty topics a month rather than having too much there. As always, let me know if there's anything you'd like me to talk about on these topics, but we will keep providing these. And as I said, you'll get some paperwork for some changes to the ownership of the group that we're licensed through. No effect at all on day-to-day operations or anything there. So till next time, this is Rob McGregor signing off.